G'day, it's Scotty North from Zenium Live, and today I'm joined with PJ Patterson from Keystone Financial. G'day, PJ, how you going?
I'm doing really well, Scott. It's a little bit chilly here in New Sydney in New South Wales, but winter is well and truly upon us. So I'm just trying to stay warm. Got the jumper on and hunkering down. Got the fire at home going at home. It's nice.
Fire. Well, it's officially winter because, obviously it's past, the 1st of June, but it also, we've had a day in Queensland where it got below 20 degrees, so that's it. Ugg
Oh my
boots are
God.
out and beanies are on the head.
So where do
Mate,
Queenslanders go for the winter? When it
mate,
gets
that's
that cold,
that's
that's freezing.
mate, it's hard work. We have to sort of head north to Cairns or something.
Yeah.
So,
Wow. Your
what
your
can I
holiday house
say?
in Cairns.
Yeah, that's right. Yeah, to go out in the reef. All right. Well, look. While we're talking all things Australia, yesterday we had some news come out that we've all been kind of waiting on all as in all us financial nerd freak guys, geeks, that are waiting on some figures, right? And those figures were the GDP figures that came out for Australia. And mate, do you want to go through what they came out and what that means for people?
Sure. So yeah, the long anticipated awaited GDP figures for the March quarter, so the 3 months ending in March, weren't probably as bad maybe as had been predicted, but we still saw a negative GDP print quarter over quarter. So it was minus 0.3% in March. And whilst that is not two consecutive quarters yet, I think, and I'm sure we'll talk about what may happen in the June quarter, but it is one of the first negative quarters we've had for a long time. And almost immediately, the Treasurer, Josh Frydenberg, came out and said Australia was in recession. So obviously, the policy wonks and the guys at Treasury probably know something about the June quarter stuff already. That they, have indicated to the Treasurer, hey, it's not going to be so good. So we'll probably have a technical recession confirmed sometime, I guess, in August or September when we get the GDP numbers for the June quarter. But that was not good. The year-over-year GDP figure, though, was as expected, 1.4% growth. So not a complete and total disaster. But the March quarter, we didn't see a lot of the COVID stuff really affecting the economy. So I think it's telling that we were already seeing a slowdown and decline in GDP in the March quarter, and it sets up for us to have probably a really bad June quarter. So we'll see what that looks like
No,
in
that's
a
fair
couple
enough.
months.
And so, just to confirm, GDP doesn't mean get dressed properly. Like, what does GDP mean?
Yeah, GDP, for those of you that don't know, is a gross domestic product, and it is a measure of four things: government spending, consumption, net exports, and what's the fourth thing? I can't remember the fourth thing. Government spending, investment, net investment. So that would be like business spending and so forth. So in that category, I don't know if you have a chart on that. I know you had one chart, Scott, that we were going to show. I'll see if I can find it real quick. But we did see that net exports had risen. They contributed, net imports had risen. So we saw that contribute positively to GDP. But other things like consumption and some of the other measures contributed negatively to GDP. So I suspect that consumption in particular figure will continue to be a drag on GDP in the June
Yeah,
quarter.
okay. The chart I've got here, and for those listening on our Real Property, Real Wealth podcast, is an international real GDP growth comparisons chart. It was actually came out from ScoMo. I grabbed this from his Facebook page. And that's a comparison between Australia, Japan, Korea, United States, the OECD average, United Kingdom, Canada, Germany, France, Italy, and China. And that's the order in terms of least to most drop in GDP on this graph. So we're starting at minus 0.3% for Australia, all the way down to minus 9.8% for China. So, mate, 9.8% negative, that's a big number for China.
Yeah, it is a big number for China. And I think they're a little bit ahead in terms of the data. So some of that data there probably factors in a bit more of the COVID stuff. But certainly, I think we're going to catch up. So you're going to see Australia catch up to some of these other countries when we see that June that June GDP print. So they probably put that chart out just to say, hey, look, it isn't as bad as it could be if you look at, say, China at the other end of that chart, but certainly negative GDP growth is not good.
Yeah, for sure. Yep. And so you talked about the consumption. I mean, with GDP being consumption. So that's probably a no-brainer, right? I mean, we're in lockdown. It was hard to spend. I mean, you could spend online, but I mean, by simple fact that we weren't driving, there'd be consumption lower. There's all sorts of things. You're not getting a coffee out. You're not doing this and that. So, absolutely, it's probably not unexpected. I guess that comes down to my question is, well, is that must relate to stock markets? Okay, so when we usually get these negative reports, we see stock markets, tank, or we get a positive report, they go up. Stock markets didn't really necessarily respond this way this time around. Is that because they'd already sort of accepted the fact it was going to be bad, or they'd priced it in, or what's the go?
Well, it is very interesting that certain stock markets have responded recently to market activity positively. So the U.S. stock market has been, over the last sort of 5 to 7 days, has been rallying. And I think a lot of that has to do with the Federal Reserve in the U.S. has been buying stocks now. They're supporting the economy, obviously, with a lot of money printing, and they're really selectively trying to prop up that asset market. If you juxtapose that against a lot of the global stock markets, it isn't necessarily the case. So stock markets in the Asia region, so the Hong Kong, Shanghai, Taiwan, Korea, are all continuing to deteriorate, and they're not really rallying. The Australian market is probably somewhere in the middle. It's been going up a little bit off the back of, probably the currency bump that we've seen in the last few days. The currency's gone from around 62, 63 to about 70 cents. But it isn't back to where it was before the crisis began, which was about 7,000. So there's still a long way to go. The Aussie market peak to trough was down about 39%. It's now still down about 13, 14%. So again, we haven't recovered the entire amount of the downdraft that we saw during the initial stages of the crisis, but it has recovered quite a bit. Now, I actually think this is what is called a bear market bounce. So a lot of people that are market participants really are desperate. They want to see a V-shaped recovery. And a lot of people are talking about a V-shaped recovery, or what shape will this recovery be? And they're desperate to see that V-shaped recovery. So in some respects, I guess, expectation or desire is going to create some of the activity that's in the markets. But I think as we get through the next quarter and on the back half of this, and really see, once the economies reopen, really see what is going to transpire with further data, we're going to potentially see a repricing of markets. So I guess what I'm calling for is that this euphoria that we've currently got going in markets is probably not going to last much longer.
Okay. All right. Now that's interesting. So do you want to quickly touch on a V-shaped recovery versus a W, an L, an I?
Yeah, sure.
I don't know. What's the differences?
Well, yeah, it's a good question. So I don't know if there's an I-shaped recovery. I think that's just a crash and it's a flat line, really. I'm not sure. Right. But a V-shaped recovery would be, a sharp downturn and a really sharp recovery. So it would sort of fall and then it would rise almost as quickly as it fell. And that's a pretty unusual thing to happen. Those tend to happen in more shallow drawdowns, where you might see a 10 or 15% correction and then an immediate bounce back. But we really saw during this crisis a pretty significant drawdown in the S&P 500 and the ASX All Ords as well. So that would be a V shape. A W is more likely what we're going to see, which is you'll have that sharp decline. You'll have a recovery of some description back to a certain point. It won't go all the way back to its previous high. Then it'll fall off again, and it may test the lows that were put in during the initial phase of the crisis, or it could blow right through that and continue to new lows. I don't know what's going to happen in that regard, but there's a lot of things that go on in markets. And one of the issues right now that we're seeing that is maybe causing the price of markets to go up is that earnings haven't really, the earnings from companies haven't fully been priced for I guess, the downturn in earnings. So we're starting to see companies guide lower. We've seen earnings reports coming in lower. We saw the S&P earnings for this past quarter down almost 8%. And that's the beginning of the crisis. So we're going to continue to see, I think, information coming into the market that's going to, for a lot of traders and participants in the market, they're going to call to question, is this whole thing over? And I think the answer to that is not by a long shot. So the other types of recoveries that we could get would be a U-shaped recovery, which would be maybe more of a long drawn out recovery. And then an L-shaped is just sort of a downdraft and then a flat line at a certain level for a period of time. And then, there could be other shapes of recoveries, but the V and the W are probably the most popular. So I think we're going to see a W, which just means down, up, and then who knows, down again, up again. There's going to be a bit of chop for sure.
Yeah, okay. So that doesn't, okay, so I guess my question coming here is because I talk to a lot of people every week, and we talk about all sorts of things, property and finance and all that sort of stuff. But I guess everyone wants to know what's going on in the future. And we've had a few of these discussions when we get you on, and this and the way you structure things for your clients and the way you look at things. I suppose the big, how long can a bear market bounce, you called it, go on? I mean, are we expecting some sort of major negative news to do that, or will the market just sort of run out of steam?
It could be a bit of both. So right now, there are a number of correlations in markets that can cause them to rally or fall. And one of the key things that drives markets are interest rates. And interest rates right now are historically low. And another thing that drives markets are other events that come from other areas. So we saw, for example, all this stuff that was going on in the oil market has caused a lot of problems, and that isn't over either. So the fact that the U.S. dollar, which is a big driver also of what goes on globally, the dollar has started to weaken against a lot of currencies, would suggest that people are expecting that we're getting to the other side of this economic downturn because capital is now flowing out of the U.S. and back into emerging markets and a few other places. But again, I'm not sure that they aren't maybe a little too early in unwinding their trade into the U.S. and into the safety of treasuries and the U.S. dollar. Time will tell. But again, I think it just goes back to the data, the earnings data that we're going to see coming through from companies in the second quarter of this year is going to be really bad. And so right now, I guess really the way I should put this is we're seeing that sort of relief rally. People are able to go back to work. The economies are restarting. There's hope that we're going to see economic growth and a return to normalcy. But I don't think that that's going to happen as quickly as people think. So one of the things I'm reading at the moment, as an example, is that there's 40 million jobs that have been lost in the U.S. since the beginning of this crisis. It's all the jobs created since something like 98 or 99 or whatever have been wiped out. And employers are not going to put those jobs back on straight away. So we're going to see a real lag in employment. And that's going to be a drag on the economy because, of course, if people aren't going back to work, they're not earning, they're not able to spend, and consumption is one of the biggest parts of GDP. So if they're not out spending, they're not going to restaurants, they're not going to retail shops, we're going to struggle for a while. And we're just not going to see that data for a number of months as the economy reopens. And I guess you talked about you asked me the question a minute ago, what could cause this to derail? Well, if COVID-19 comes back in any great force, like if we all get back together and start to mingle again and cases start to go up, I'm sure that the reaction from government will be to, fairly swiftly shut down the global economy again. But we'll see.
Yeah, okay, that's a good point. I mean, we've seen some extracurricular nighttime activities going on in the US of late as well, the past week or so. And, one of the things I was very happy to see in that was that most of those people were wearing face masks. So they should be right for COVID, but they will get a brick thrown at their head. But that sort of stuff surely can't do much to underpin confidence in markets, right?
Well, certainly the domestic economy in the U.S. is going to be having a number of disruptions going forward, and if these protests and riots, continue to cause disruption there, then that'll eventually have to get priced in. At the moment, I think people probably figure that that'll run its course as the anger and everything else that's sort of bubbled over around this, situation subsides and people calm down. But you never know. I mean, this could be that event with George Floyd, I believe was his name. That event and his killing, his murder, might have been the last straw for a number of communities and particularly the Black community in the United States. So we'll just see how that plays out over time. But certainly, just back to the idea of how this economy really starts firing again. People have to get back to work. They have to be able to earn, and of course, in doing so, they can go out and spend. So one of the big questions I've got too, and just circling back to Australia, is the job seeker program that was put in place. That finishes around September, I believe. The benefits from that finish, and of course, a lot of people who were getting job seeker benefits, that should probably start to scale back through July and August of this year. So we're going to see again how that's going to affect the economy here in Australia, and I think it'll start to show up in various metrics and numbers. But again, we just have to wait and see what the data says.
All right, so let's talk about back on the GDP,
Mm-hmm.
and consumption is a big part of that. I mean, I'm putting you on the spot here, but you talked about the four aspects of what makes up the GDP. So
Mm-hmm.
how much is like what I call internal or national consumption a part of that? Because and just before you go on that, sorry, is the reason I'm asking that is that with international borders still closed, are we right in thinking that we can kind of self-spend our way out of this just with Australians dealing with other Australians?
Good question. So the consumption, our economy is about 65 to 70% consumption based. So that number is huge in GDP. It is the biggest number of the GDP calculation. It is in most Western countries now. And that's predominantly because, of course, manufacturing would have been a huge component of that 50, 60 years ago, but it's, all that's been shipped overseas. So consumption now forms the largest part of our GDP, really. And as you alluded to, the economy was shut down. People can only spend so much on Amazon before they just get, tired of internet shopping. And their normal routines have been disrupted. So they're not going out to the shops. Some of the metrics I've seen, for example, groceries and eating at home has just taken off. So one of the questions that's being put out there in terms of behaviors is, will people go back to their previous behaviors? Will they go back to spending? Will they go back to eating out as much? Will they go back to, all the shopping and all the other things they've done? Or have we seen perhaps even an awakening, some sort of, I don't want to call it a spiritual change, but have we seen some sort of shift where people are like, I actually don't need to go out all the time and spend all my discretionary income on stupid stuff. Maybe I should save more. So in fact, the savings rate in Australia has gone up. That's probably just a function of people can't spend. Couldn't spend because they didn't have that outlet. So that'll be a number that'll be interesting to watch. The savings rate, is that going to continue to tick up, or will that start to go back down? If that starts to go back down, that'll probably be an indicator that people are getting back into, their spending. So consumption is huge. The corollary of that is consumer confidence. So the consumer confidence number obviously went into the toilet. People were scared because of COVID. They were, we had a run on toilet paper in Australia and in the US. That was crazy. So
Yeah.
consumer confidence went into the toilet. How quickly would that recover? Oftentimes, things like consumer confidence can recover quickly. But I mean, we just don't know. We really just don't know. We're very early days in reopening the economy now. And it's just going to be interesting to see how it unfolds.
I think that the toilet paper is an interesting one. We've touched on that before. I mean, that's sort of the pinnacle of panic buying and spending all at once and all that sort of thing. You comment about savings being up predominantly, possibly because people can't spend, is an interesting one as well. So we might touch on that at another time.
Mm.
when we can get some more data on that, because I think that would be really interesting to delve into that. One thing I wanted, the last topic I want to go through before we depart for our coffee and cake and everything else that we do after these massive global events that we put on Thursdays,
Oh yeah,
is hey, don't play it down. We're global. I keep telling you, we're global.
we are.
Um, is recession. Okay, what's recession mean for someone? I mean, recession. Are we technically in recession? We've got to get 2 quarters of negative growth before we're in a recession, or how's that work? And if it is the case, which we think it probably will be, the next one comes out, right? It's pretty much a no-brainer. Everyone's going, well, I can't see that turning around now. What does it mean? Do people need to act differently? What can they do to their money? How do they create wealth in this time?
Another great question. You're just loaded with good questions today, Scotty. Recessions are technically defined as 2 quarters, consecutive quarters of negative GDP. However, you don't necessarily have to have a negative GDP to have a recession. So just imagine if we had, this negative 0.3 rate of growth that we've just had in March, and then we only had 0.1% growth in June. Now, I'm not saying that's going to happen, but let's say it was 0.1. That's a pretty terrible number as well. Now, even though it's technically not a recession, I would call that we're in recession because our growth rate is just almost non-existent. So you can really have a recession without actually technically having a recession. So what recessions really look like are unemployment is increasing, wage growth is stagnant or falling, things like spending are down. You're seeing mortgage delinquencies rising. That's just to name a few. You're probably seeing employers putting people off and not rehiring them. Sound familiar? Like this is what's been going on over the last 6, 8, 10 weeks. So that's the technical definition of a recession. We're probably actually in sort of a depressionary environment, maybe not full-on depressionary environment here in Australia, but certainly in parts of the world like the US, it's probably more akin to a depression with the negative numbers that they're seeing. And then you move from that environment into more of a recessionary or even a stagflationary environment. So what's likely to come down the pike next for us Australians and globally is an environment where we see growth still being pretty dismal or flat or even negative, but we see inflation start to pick up, and that'll be the function of that will be all of the money printing and all of the liquidity that the central banks have provided to the banking system, and that money will start to filter its way into the economy, and then we may very well see inflation start to creep in. But again, those numbers, we'll see those numbers begin to show up in things like, fuel prices will rise, costs of living will begin to rise while wage growth is stagnant. And stagflation is a horrendous place to be. You just don't want to be in a stagflationary environment. The best place to be is either a deflation, which is really what we're in right now, and that's best for you and me because it means our purchasing power rises, or just an outright inflationary environment where growth is up, wages are up, inflation is up, and all boats are sort of rising in that rising tide.
Yeah, I commented on someone's Facebook post. They put some data up there, and it was about the coming crash in the market and all this sort of thing. And I jokingly said, "Don't worry, it won't be a crash. We'll have a soft landing with all the extra cash they're printing right now. It's just like the foam pit at a gymnastics stadium, except with cash instead of foam." And I guess the point being that we've kind of teased people a couple of times on the last shows that we're going to talk about how this money printing works and stuff, but we really want to talk about the GDP and the get dressed properly figures and stuff, what have you, this time round because we're due for our market update. But I think next time we really got to go into this money system and how it works, because that is probably by far in the top 3 questions that I'm getting when I talk to people is, well, we're going to have to pay this debt back, or how are they getting this money? Or it's all about the amount of money that's being printed. So I don't want to go into it now, but I will say we have to cover this topic, mate, because I keep getting asked this question.
Yeah, it's a more lengthy topic, and certainly there's a lot of sort of technicalities to it, but it's fascinating when you really get into it. And actually, bringing that up leads me to something I did want to bring up, which was the early release from Super. So that is something that has probably had a little bit of an effect on our economy. But I thought I'd just mention it because I know there were, I've been dealing with it in my client base. A lot of people have questioned me about taking money out of Super early, and if you have done that, and the stats on that are that something like 1.8, almost 1.8 million Australians had indicated they were or had applied rather to take out some money, and about 1.63 million had actually taken money out. So something like 12 or 13 billion dollars, as at this article, which was I think printed yesterday, had been taken out of the superannuation system. Now, the superannuation system's huge. It's well over $1 trillion worth of assets. So 13 billion isn't a massive amount of money. But what do you think the number one and two things were that people spent money on? What do you think number one was? Let's have a guess.
Number one?
Yeah.
Okay, so they spent money on, I don't know, a boat?
It wasn't a boat. It wasn't a boat. They actually reduced debt, so that's
Okay.
positive.
Well, I was going to say that. I thought that'd be good, but I thought maybe this isn't good. Maybe they just wanted to go on boating.
Yeah. Well, the number one thing was debt reduction. So that was probably a good thing, and I'm sure that's credit card debt. It doesn't specify what type of debt. But sadly, the number two thing that people spent money on was gambling, and I just thought that is
I thought
that is
everything
crazy.
was closed. What's that? Was that online gambling? Like I thought the pubs and stuff were closed.
Well, I'd say it probably was online gambling because you're right. All the pubs and certainly the casino was closed. Luckily, number 3, 4, and 5 were sort of just consumer-related items. Food was number 3, thank goodness. But clothing and department stores number 4. Number 5 was automotive and sort of buying petrol and stuff like that. So anyway,
Mate, toupees and wigs didn't make it because that'd be all right. I'll get access to my super and
that wasn't on this list. That could be down at maybe number 70 or 80 on this, but they only went to about 15 things. So we'll have to find out if toupees and wigs are on there. But it's look, I bring it up because the conversation I was having with clients was, I said, well, do you really need to take the money out? And I had a few of them saying, well, we just want to take it out just in case. And I thought, that's kind of like that isn't the intent behind why they allowed this to happen. And I think the stats show, that people sort of abused it in some respects. I think debt repayments probably okay, but a lot of people also went in and applied for the deferral of, loan repayments and things like that. And that's another issue that could be a problem for our economy come September, October, because people were allowed to defer repayments on their mortgages and in some cases business debts up to 6 months. And so that, that's going to restart sometime September, October, November. So again, we'll see when all of these things start to unwind, all these benefit programs and the stimulus programs or whatever, they unwind or they subside. What is actually going to happen? And I think again, that's where we're going to see. We've seen a bit of the V recovery, and that's where we're going to go into that W. We're going to go into that downturn again as we see the stimulus programs and other things unwind. So just be mindful of that, I think, is the main message.
Yeah, and I think we need to cover on another show is the difference it makes if you have deferred, they call it mortgage repayment deferral, that a lot of them, it's either they will defer by the same amount of time, but there's still generally an increase in the monthly cost. And so we're coming back from zero, effectively there's no payment going on now. So you've almost reset your budget, your house budget for that, your home budget, and back to an amount that is potentially higher than what your mortgage payment was when it turns back on. I think that's going to cause that's a shock, right? That's a shock waiting to happen. And people, I don't think, are really prepared for it.
Well, and they probably aren't. And, if you think it through logically, what are the reasons why someone would have deferred a mortgage payment? So likely reasons would be that they had a reduction in their pay or they lost their job. Again, the question will be, now some of the people that had a reduction in pay, they'll probably return to full-time work and back to normal pay. I think that would probably occur. Most letters I've seen around this, they're saying, your pay is going to be reduced from this date to this date, and then whilst we reserve the right to review it, it'll go back to normal as of a certain date. So I think those people will be okay. It's the ones that have lost their jobs that they're going to be in, it's going to be a trifecta of problems for them. They're going to have, loss of job. They're going to have a higher mortgage payment. And, potentially someone, else in their family, could be a partner or whatever spouse, may not be, also may be not working or have some issues. So we could really see some real problems coming up later in the second half of this year, I guess. That's where we're really going to see whether we're going to have extended problems in recovery and we're entering or we're in a real depressionary environment, or we're out the other side and we're back to normal growth. So most bear markets typically last 12 to 18 months, and we're probably in month 3 or 4. So that's why I think people should still be cautious and not get too feel the FOMO, fear of missing out on these stock market rallies, and just pick their spots as to whether they what they should buy if they're going to be in equities or whatever, and even property, and when they should do it.
Yeah, no, that's good. And look, we're out of time. I'm going to leave you with this: is that one of the conversations I had with someone this week who was a little bit in the know was that the general consensus out there is all this sort of stuff that we're talking about now is this culmination of, we've had this storm, but it's almost like the damage is not going to be seen till further a little bit down the track. That October to January is what I said last week on the show in terms of property. We're probably going to see the full effects. The question then comes into, well, how much will the government step in, if at all? Right, I'm not saying I have this answer at this time. I'm not saying they're going to keep JobSeeker and JobKeeper going, but we've seen this week with the building bonuses come back. The building bonus is always something that gets thrown in these times, and it's like, hey guys, here you go, with Renault sort of thing, and we're waiting on the exact figures, the exact terms to come in on that, and I'm kind of watching that fairly closely. But I wouldn't hesitate to say we'll probably see quite a few of these type of government programs coming out to essentially try and stimulate the economy, and I think we're going to see that.
Yeah, I agree. It's the building bonus thing. I saw that announced today. That was quite interesting, that they have chosen to prop up the housing market. I think that's the last, I don't know if we talked about this on air or not, but that's one of the last pillars of our economy is construction and housing. And clearly that's, they must know something about the numbers in terms of building approvals, even though the building approval number was okay. I think it was announced yesterday, but they must know something about that market. And clearly they want to keep it going, because if that falls over, we're in real deep doo-doo, because we don't have tourism anymore. There's a whole, bunch of our segments of our economy are in dire straits. So if we got to keep construction going. So it's interesting that they've done that. So yeah, I agree with you. We'll have to see exactly what the impact is, and that'll be felt over multiple quarters, because, people renovating their homes, that takes a long time.
Yeah, look, renovating a home can take a lifetime, and that's a topic for another day. All right, PJ, thanks very much for joining us today on Xenium Live. Look, if anyone wants to join, you need to join up, right? Get across all this information, keep up to date with what we're doing. We've had it scrolling the whole time at the bottom of the screen. However, if you're on our Real Property, Real Wealth podcast, you can't see that because it's only audio. So you need to go to www.xenium, that's xenium.property/join. So that's www.xenium.property/join. There's no .coms, no .aus, because as I keep telling everyone, we are global. Also, our phone number is 1300 66 7789, and you can hit us up for any information on that. And don't forget, as PJ always reminds, and I beat him this time, is to contact us for topics and feedback. We love that. We love to be able to have topics to get in depth with, deep dive, as they say, and go into and be able to tell you guys how things work behind the scenes in property and finance. We love doing that sort of stuff. And feedback, we love feedback. We often get feedback on Facebook. It's mainly me, PJ, on how good I look and how well I present.
What a great host
sometimes
you are.
Sometimes we hear the odd thing about you as well, but I sort of don't always pass that on.
Yeah.
So, yeah. All right, mate. Thank you very much for joining us. So we'll see you again in a couple of weeks. And Xenium Live is back next week for American Mondays, where I get to show you how I started off in the States looking for high cash flow property And we've got Property for Chicks next Wednesday. They've got 2 weeks of Property for Chicks. So join that next Wednesday and the Wednesday after. All right, I'm Scotty North. This is Zenium Live with PJ Patterson from Keystone. Thanks for joining us.
Bye-bye.
See ya.